Hey everybody, Dave here, Hidden Freedom Investing. In today's video, I want to go over the top 5 dividend stocks for April 2021. It's getting very tough to find some quality dividend stocks that are on sale or even at a slight discount. But I came up with a list of 5 that I feel like are a pretty good discount, and so we're going to go over those top 5 stocks today. If you're new here, I do dividend portfolio update videos, and here is my dividend portfolio overview here. And this is all my stocks, including the health of the accounts and all that. So if you're not familiar with my dividend portfolio update videos, you can take a look at the card on the top right here. And that was the last dividend portfolio update video I did if you want to see all the positions in the dividend portfolio. So let's go ahead and get started. The information expressed in this video is my opinion and my opinion only. This information is for entertainment purposes only. Please do your own research. The first stock we're going to talk about here is Merck, and basically I think this one was recommended by somebody in the last top 5 video I did, and I looked it up, and I am familiar with the company, but I was pretty surprised on where it's sitting at. I think I did that last video about on here, so it's come up quite a bit since then, but still, it still seems to be a pretty good discount. This number right here at 76 bucks looks like we had a lot of support and resistance right around that number of $76 right here, going all the way back to November, and then literally going all the way back to July of last year, and then also back to June. If we go on a little bit bigger view here, we can see that 76 is a pretty good point going all the way back to 2020 in May and June, and then obviously that was the pandemic right there. And we can go all the way back to 2019, where we pretty much had this kind of support resistance anywhere between 72 to 76. So right now at this time the stock is down 6.94% year to date, and you get the 52-week range being 71.71 on the low side. On the upside, and we got 87.80. So there is a lot of room to move up and not a lot of room to move down, in my opinion. Obviously, that pandemic was a pretty big low right there. Looking at Seeking Alpha here, Merck has a 3.43% dividend yield. Payout ratio is 39.93%. 5-year dividend CAGR is 6.72%. And the dividend growth is 11 years. That could be off by a year or two. I looked at another source and it looks like it's 10 years in that source, but it should be close about 10 or 11 years. Looking at the dividend history for Merck, we can see that they raised the dividend in 2020. Right around that last quarter right there, so from 61 cents to 65 cents. They obviously paid out their first dividend in 2021. So technically they don't need to raise the dividend all the way until sometime in 2022. It could be in December of 2022, it could be any time in 2022, as long as they raise it at some point. By a cent or two or something like that. So here they raised it 4 cents. They could raise it by 4 cents, and that will count and keep them running for a dividend aristocrat. And right now they're at 10 years, so they're quite a ways away from being a dividend aristocrat. This is not a stock that I own in my dividend portfolio. Just want to make that known that I do not own this stock, and I do not have any intentions of buying it at this time. And if it gets down to 72 or so, I may or may not execute a trade on it. But right now I do not own it. The next stock up is Realty Income Corporation. So this is a REIT. If you're not familiar with the Realty Income, it is one of the best REITs out there in my opinion. It is a dividend aristocrat. They did pretty well during the pandemic. And you're probably thinking, Dave, what are you bringing this stock up for in April of 2021? Well, it looks like it's about to break out. And obviously going back several months here, we can see that it's kind of been not falling out of this channel here. On the low side, around this 57, and this upside around 65 to 66. It's kind of just been hanging around in that channel and kind of trading sideways. But if we kind of zoom out here into a weekly, we can kind of see that going all the way back to 2020, that 66 to 65 level is resistance. And obviously prior to the pandemic, we're all the way up to 81, almost 82 here. So I feel like there's a lot of upside in this stock, and right now the stock is up 5.44% year to date. On the low side, 52-week low, we had 47.68, and the upside was 66.80. I feel like this stock is ripe to break out of this channel that it's been in, and it looks like it's about to do it now. Obviously, this is pre-pandemic here, and obviously a lot of the retail clients did not go away. I mean, just AMC and some of their gyms and all that had trouble, but in general, if you kind of look at their earnings statements and some of their more earnings releases, they actually picked up a lot more properties during the pandemic, so that was pretty good. So technically they're doing better than they did in 2008 during the financial crisis, when the real estate really went in the toilet. Realty Income really shined this particular recession and picked up a lot more properties at a discount, so they are doing a lot better this time than they did last time. So I don't know what's really holding the stock back at this point, and I feel like it's just going to break out, and even if it does drop down to 60 at this point, it's still a good purchase to pick up more there. But at 65 here, it's still a great purchase because you got a lot of upside here where it was prior to the pandemic. Look at the dividend summary for Realty Income. We have a 4.33% yield, and this is a monthly payer, by the way, so you do get paid monthly. And obviously it was 23 cents per month, and they just actually increased their dividend recently. Payout ratio we cannot go by. Well, actually that actually looks correct, believe it or not. So yeah, you have to use AFFO payout ratio, not the normal standard payout ratio. But this actually does look correct, so I don't know if somebody's manually intervening with that, or if they know that this is a REIT and they're calculated off the correct numbers. But it is about 83% when I did the calculation. 5-year dividend CAGR is 3.89%, and the dividend growth of 24 years is actually incorrect. They are a dividend aristocrat, so I believe they're at 27 years if I'm not mistaken. In their dividend history here, we can see that they pay monthly because they paid out every single month in 2020. They've already paid out 3 months here in 2021, and they did raise the dividend right there in March. So they don't technically need to raise all the way until the end of 2022 or sometime in 2022. But Realty Income also tends to raise several times during the year. Like last year, I think they raised 4 times during the year. So expect them to raise, at least 2 or 3 times this year, probably up to 4 times. It's not a big increase. It's a fraction of a penny, but it all adds up in the end. Realty Income is a stock that I do own in my dividend portfolio. Here it is right here. Do own 147 shares, and that's across 2 different accounts. So I do have a tax deferred and a taxable account. And the tax deferred account, I own 141 shares. In the taxable account, I own about 5 shares total. Obviously, because it is unqualified dividend, I carry most of that in the tax deferred account. Scrolling over the right here, we can also see that it paid about consecutive 28 years of dividends. That makes them an aristocrat, and so that tells you that Seeking Alpha is off slightly. If you're enjoying this top 5 dividend stocks for April 2021, go ahead and like and subscribe and hit that bell notification. The next stock up here is AT&T. I've been following the stock for quite some time. I've done quite a few earnings release videos on AT&T. I like where it's at now, and you're probably thinking, well, this is kind of expensive, but it really isn't. And it is what it is. If you're not familiar with all the things that they've been doing, they are coming back alive, and they are also a 5G play as well. Well, they did pay quite a bit for the 5G spectrum, took on quite a bit of debt, but they did sell some assets as well to pay for some of that debt. They had been reducing the debt for the last several quarters, and they were making progress there. So this is a turnaround story, a reopening play as well, and that's kind of this, the reason why it's been running up here, because of, basically the reopening play. But in addition to that, it is also an infrastructure play as well, right? We just had, a big infrastructure bill, and it looks like that should help AT&T considerably. Right now, it is up 7.55% year to date. On the low side, 52-week range, we had 26.35, and the upside we had at 33.24. So if we zoom out a little bit here, we can kind of see what was going on. And obviously, the low is right around this 27. Obviously, this during the pandemic that we had here was the ultimate low, but I'm kind of just looking where the support is, because this drop here was just more fear than anything. But obviously, a big pickup for this stock would have been right around this 28 level here. But still, I think this level right here, we can go all the way back to 2019 and part of 2018, and we can see it kind of hanging around this level right here, and that's kind of where we're sitting. So this, in my opinion, is a reopening play, not to mention it is also an infrastructure play, and that's the reason why I think it's a good buy right at this level here, about 31. Obviously, look at all this upside here. This is prior to the pandemic, so we have a lot of upside here, right? And I know this stock is, one of those ones where it's got too much debt. People just don't like it because of that. And, it is what it is. You really need to understand that they are changing the perception of the stock. And I think you're just going to be missing out if you don't pick it up at some point. You're going to be kicking yourself. It just pops up to 34 and just goes north of there. Because there's a lot of tailwinds that are going to be forcing this stock up, in my opinion. You got 5G, the infrastructure play. You got HBO Max, which is killing it, by the way. And once international roaming comes back, there'll be, that's like a triple-edged sword right there, if that's such a thing. Looking at the dividend summary for AT&T, we got a dividend yield of about 6.71%, payout ratio 66%. And obviously, that's calculated differently than how AT&T calculates it, but that's fine. They use a different ratio in their earnings releases than what they're showing here, but still, 66%, it's actually pretty darn good. 5-year dividend growth rate is not very good, but that's pretty typical of a communication sector stock. What, 2% there? It is what it is, but you're going to get a little higher starting yield there. Consecutive dividend growth rate is 36 years. We'll just double check in my spreadsheet to see if that's correct or not. So we're looking at AT&T, which I have right here. So I own 328 shares of AT&T. That's across 2 different accounts, okay? And we're looking at 2 accounts right here. So here's the tax deferred account. I own 72 shares of AT&T in that account. I also own 256 shares in my taxable account. And then we also have, let's see, with the Dividend Aristocrat, 36 consecutive years of dividend increases. It started the first streak in 1985. The next stock up here is Hormel Foods, and I kind of searched for this one and came up with this one. I kind of looked at the chart and I kind of liked where it was sitting at. So let's go and talk about this stock here a bit. And right now the stock is sitting at $47.53. Obviously, that is pretty much of a sticking point right there, literally going all the way back to 2020. And we'll zoom out here in a second, but here is the stock right here, and if we kind of draw a line all the way across, a lot of sticky points here, sticky, 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 sticky. And all these points here are sticky, including these here and all these here. So, in my opinion, this is a great stock at a great price. It is up year to date 1.97%. 52-week range is on the low side, 43.45, which is probably right here. And then we got the upside of 52.97, which looks like it was probably right here, which was last year. So if we zoom out a little bit here, let's go to a weekly. And here was the pandemic right here. So it's kind of come up, and it's kind of interesting because this was not necessarily a pandemic play because, it could have been, but it couldn't have been, right? People staying home, so maybe they were preparing for an apocalypse or something like that. Did I even pronounce that right? Apocalypse. There we go. Maybe they were preparing for that, so they're just putting a lot of Hormel up. I don't really know. It looks like it did recover quite a bit, and then recently it has kind of trimmed down a little bit in late 2020. But, I would say on the low side, 46 is a pretty good point because you can go all the way back to 2019. It's kind of sticking right there. And then literally all the way back to 2018, it's sitting right there at the 46 level as well. So on the low side, I'd say 46 is a great pickup. But at this point, I also think it's a pretty good pickup on the upside as well. Just given where, it's not blowing up and it's not too crazy overvalued or anything like that. In the dividend summary for Hormel Foods, the dividend yield is 2.04%. Payout ratio is 56.39%, which is, pretty darn healthy. 5-year dividend CAGR is 12.63%. That is actually pretty darn good. That's pretty strong. That's pretty healthy. And then dividend growth, I believe, is wrong. I believe they're a dividend king, if I'm not mistaken. So I believe they have been raising their dividend for at least 54 years consecutively. Looking at Hormel Foods dividend history here, we can see that they raised the dividend in 2020 from 21 cents to 23.25 cents. They've already raised in, it looks like 2021 right here, to 24.5 cents. They raised it up roughly about a penny or so, and they most likely won't raise again in 2021. So that means they have to raise in 2022 at some point. Hormel Foods is not a dividend stock that I own in my dividend portfolio, and I have no plans of initiating a position in Hormel Foods at this time. Go and comment below on your favorite stock from this top 5 video. Go ahead and like and subscribe and hit that bell notification. And the last stock here is Apple, and I should mention that all these stocks are in no particular order at all. So it's not saying that Apple's the best bet here or anything like that. I just put these in kind of a random order, and so just be aware of that. So here is Apple right here, and right now Apple's sitting at what, $127.90. It has come up in the last week or so, or when I was looking at it, it was down here, and so it is what it is. It has come up quite a bit since then, but that's fine. It's still down year to date, down 3.61% year to date, and that's because of the tech wreck due to the treasury notes and yield going up. And the 52-week range on this stock is 64.75 on the low side, and on the upside we had a 145.09, which was right here. And it looks like it's come down since then. Like I said, the tech wreck kind of hurt it, but that's fine because that kind of gives us a buying opportunity. And we're sitting about right here, which literally goes back to the number right here, here, all these numbers right here. So it is sitting at a great point to pick it up, in my opinion. I would say this little gap right here, it's not a little gap, I should say, it's a pretty big gap, is a little worrisome. Apple tends to be a gap closer, so I would assume that at some point that gap will close. Who knows when? It could be the next 20% correction or something like that. Maybe it will drop down there and close that gap. It's quite a ways down. It is what it is. It could take several years to close that gap, but I'm just, maybe it won't ever close. I don't know. I just know I've been trading Apple for many years, and it is a gap closer. Scrolling out a little bit here, obviously looking at this chart here, it's like, wow, Dave, this thing is way overvalued. Look at it, we're down to 60. Back during the pandemic, look how far this thing dropped. It got down all the way to 52 bucks, but they did very good during the pandemic. It's not really a reopening play. It wasn't really a shutdown play or anything like that. They did very well. People need their phones. They upgraded, used stimulus checks to upgrade their phones. Maybe, they're a partial infrastructure play. I don't really know if that's the case or not, but it's pretty cheap at this point. All things considered, 27 forward PE would say it's not cheap, but I'll tell you what, you give this thing 5 or 10 years, you're gonna be kicking yourself not picking it at $1.27. Looking at the dividend summary for Apple, we can see that it has a dividend yield of 0.65%. That is nothing to get excited about, I can tell you that right now. They have so much free cash. I don't understand why they just don't at least double that. It's not going to hurt them one bit, and it might make it a little more enticing to own, but what are you going to do? Payout ratio 18.67%. That tells you that they could afford to double that with no issue at all. Come on, Apple, you're not a growth stock anymore. I mean, they technically are, but in my opinion, it's like you can transfer out of that growth status a little bit and at least double it and still be considered a growth stock. But so 5-year dividend CAGR is 9.54%. And then dividend growth is 8 years. I actually think that is off by a year or two, but we'll look at my dividend portfolio and find out. Looking at the dividend history for Apple here, we can see that they raised the dividend, it looks like twice in 2020, so that's pretty cool. Went from 77 cents to 82 cents up to 20.5 cents. They have not raised in 2021 so far. and technically they don't need to raise until the end of 2022, at least by 1 penny or something like that, or even a fraction of a penny to be counted. But most likely we'll probably at least raise once or twice in 2021. So looking at my dividend portfolio, I do own Apple, and here is Apple right here. So I own 104 shares of Apple total. That's across 2 different accounts. So if we scroll over to the right here, we can see that we have 4 shares in the tax deferred account. We can also see that we have 100 shares in the taxable account, and I'm up over what, 110% in that stock, and that's $7,000 in realized gains. I picked that stock up during the recession of last year, literally in March, right near the low. I think March 20th. That's when I pretty much picked it up, so it was a lucky bet. Scrolling over to the right here, we can see that they've been paying out for 9 consecutive years, so it looks like Seeking Alpha is correct. So that's good. They are quite a ways off from being a dividend aristocrat, but they're on their way to being a dividend aristocrat, along with Microsoft, which is at 19 years. So do you own any of these top 5 dividend stocks? Go and comment below. That wraps up this video for the top 5 stocks of April 2021. If you have any comments, questions, or concerns, leave a comment below. Hit me up on Instagram, Twitter, or shoot me an email as well. Until next time, go ahead and like and subscribe. We'll see you in the next video. Thanks for watching.